Legoland Korea, 280,000 square meters, opened 2022 and it had under 500,000 visitors last year. It posted 191 billion won in losses. Legoland Shanghai, 318,000 square meters, opened July 2025 and it was the fastest in Merlin's portfolio to reach 1 million visitors. It is also a FIA award winner. The last time Legoland made its biggest Asian bet, it triggered a national financial crisis and never turned a profit. Now they are doing something 4 times larger. What is different this time and what is not? China stands out as the world's second largest theme park market, valued at $9 billion US. For any operator with global ambitions, the numbers are hard to ignore. Shanghai alone draws from a catchment of around 55 million people within a 2-hour drive. It is one of the densest family leisure populations on the planet. Merlin Entertainments, the company behind Legoland, is no newcomer here. Over the past decade, Merlin has built a portfolio that includes Madame Tussauds and the Shanghai Ocean Aquarium, giving its China team rare operational credibility and a direct line to local authorities. But the real engine behind this expansion is not just operator savvy, it is brand saturation. Lego's retail presence in China now spans roughly 350 stores, from flagship outlets in Beijing and Guangzhou to smaller shops in provincial malls. On top of that, Lego dominates e-commerce platforms like Tmall and JD.com, and its animated series air on national broadcasters. This is not organic slow-burn brand growth. It is a calculated push to turn existing Lego love into park visitation, a playbook that Korea never had the assets to run. The chief executive officer of Merlin described Legoland Shanghai as the beachhead and the Lego clubhouse, a phrase that carries unmistakable military undertones. This is about capturing territory, not simply serving demand. On paper, the fundamentals are compelling: a massive urban catchment, a proven operator, and a brand already woven into the fabric of Chinese family life. But as the Korea case proved, irresistible numbers on a spreadsheet do not guarantee success on the ground. The real test is whether these advantages can be converted into sustainable, profitable parks, not just in Shanghai, but across a pipeline that is 4 times as ambitious. Legoland Shanghai stands as both a showcase and a test. At 318,000 square meters, it claims the title of the world's largest Legoland, a scale chosen not for spectacle, but for strategic impact. The park's footprint dwarfs its Korean predecessor, and its launch was engineered to make a statement. Within its first operational year, Shanghai became the fastest Legoland ever to reach 1 million visitors, a milestone Merlin's CEO called the beachhead and the Lego clubhouse. That phrase isn't casual. It signals a campaign to seize ground, not just serve a market. The military language is deliberate, reflecting a mindset shaped by Korea's painful lessons. Shanghai's on-site hotel has operated above 90% occupancy since opening, a figure that would be the envy of most global resorts. The summer season saw nights when rooms were booked out weeks in advance. This isn't just a theme park, it's a multi-day destination, with hotel, retail, and food spend woven into the business model from day one. The park's design was built around local collaboration. Chinese architects and Merlin's operations team worked alongside municipal planners to deliver a product that fits Shanghai's landscape and taste. The result was the FIA Award for Outstanding Achievement, a prize rarely given to first-year parks and a signal of industry respect. But the real innovation is cultural. Shanghai's Miniland features over 70 Chinese landmarks, from the Great Wall to the Pearl Tower, all built with local input. The Monkey Kid Land, based on a homegrown Lego hero, draws families who might have seen the character on television or in stores. The Watertown ride, a Lego take on Jiangnan canals, is more than a nod to local heritage. It is a structural requirement for acceptance, something Korea's Western-centric approach missed. Shanghai's early numbers and industry accolades suggest the model works, yet the question lingers: can this blueprint scale to 3 more parks, or is Shanghai's success a product of unique conditions that may not repeat elsewhere? Shenzhen stands out as the most ambitious piece of the Legoland pipeline. The project's scale is staggering. It covers 580,000 square meters, carries a price tag of $1.08 billion US, and a local government has committed 30 billion yuan for surrounding infrastructure. That sum covers new metro lines, road upgrades, and a broader tourism district designed to funnel millions toward the park. Planners in the Greater Bay Area are betting that Shenzhen's 18 million residents, plus the cross-border draw from Hong Kong and Macau, can deliver the kind of dense, high-spend visitor base that Korea's isolated resort could never reach. The numbers are engineered for maximum impact. This is not a cautious rollout, but a deliberate attempt to build a regional anchor that dwarfs anything Merlin has attempted in Asia. Beijing, by contrast, follows a different playbook. The 304,000 square metre resort is smaller but strategically positioned, with a new high-speed rail stop and a metro extension built into the site plan. Regulators in the capital are less interested in spectacle and more focused on integration, ensuring the park fits into the city's existing tourism grid and supports domestic travel patterns. The infrastructure here is not just for show, it is a calculated move to drive repeat visitation from the city's 21 million residents and the surrounding northern provinces. Both projects share one thing: heavy reliance on government partnership and capital concentration. If Shanghai is the beachhead, as Merlin's CEO put it, Shenzhen and Beijing are the forward operating bases, designed to secure territory, not just serve demand. But with this scale comes risk. The question is whether these massive bets can avoid the pitfalls that turned Korea's dream into a cautionary tale. Sichuan's Legoland project was once pitched as the next frontier, a chance to anchor Lego's brand deep in China's interior, away from the crowded coastal megacities. But the path to Chengdu has been anything but smooth. The original timeline called for a 2023 opening, then slipped to 2025. Now the date is listed as to be announced, with provincial authorities offering little public reassurance. Two major delays have already pushed the project off course, and each postponement chips away at confidence that the inland model can deliver the same results seen in Shanghai, or even what is projected for Shenzhen and Beijing. Unlike the coastal parks, Sichuan faces a steeper climb. The catchment area is smaller, about 10 million residents within 2 hours, compared to 30 million or 50 million in the east. Construction costs have climbed, driven by seismic safety requirements and protracted land acquisition disputes. Provincial planners earmarked significant funds for new highways and rail links, but those infrastructure promises have yet to materialise at the same pace as on the coast. Each delay means rising costs and lost momentum, echoing the vulnerabilities that hobbled Legoland Korea: slow approvals, thin catchment, and the risk of overestimating demand in a market that may not match the scale or spending power of China's east. The Sichuan project stands as the pipeline's highest risk bet, raising questions about whether the lessons of Korea have truly been learned, or if history is quietly repeating itself, one delay at a time. $1 billion park in a megacity looks bulletproof on a spreadsheet, but the real risk is not buried in attendance projections. It is written in demographic charts and balance sheets. China's total fertility rate has crashed to 1.07, the lowest in the world. That means every year the pool of children, the core 2 to 12-year-old audience that makes up over 70% of Legoland's visitors, shrinks. This is the same headwind that blindsided Legoland Korea, where a resort built for 2 million guests struggled to break 850,000 in its third year. Merlin's own analysts have flagged that a declining child cohort leaves no margin for error. If the family segment contracts faster than new spenders enter the market, even Shanghai's early momentum could stall. Competition for those families is relentless. Shanghai Disneyland drew 14 million visitors last year, and Universal Beijing drew 8 million. Both parks have deeper intellectual property, libraries and wider age appeal, making Legoland's child focus a double-edged sword. Meanwhile, cost inflation is real. The Shenzhen park's 3-year delay has already added $200 million in financing costs. Merlin's 2023 annual report showed £195 million in impairment charges, much of it from Korea, after attendance fell short and local debt soured. Every delayed opening or missed target risks repeating that pattern on a larger scale. The honest question is not whether Legoland can draw a crowd in Shanghai, but whether the China pipeline can outrun the demographic clock and avoid the financial traps that turned Korea into a warning. In February 2026, the Lego Group made a decisive move. It acquired the entire Discovery Center portfolio from its private equity owner for $210 million. This was not a routine asset shuffle. The deal concentrated control over LEGO's experiential footprint, pulling the smaller indoor discovery centres under direct LEGO ownership, and freeing Merlin Entertainments to focus capital and management on full-scale Legoland resorts. For the China pipeline, this signals a new phase, one where future capital is no longer split between dozens of small, low-margin centres and massive high-stakes resorts. Every dollar now flows toward the 4 Chinese parks, amplifying both the upside and the exposure. LEGO executives described the reorganisation as a way to align brand experience and financial governance, with the aim of avoiding the kind of impairment charges that haunted the Korea project. By consolidating assets and tightening oversight, the group hopes to spot underperformance early and intervene before losses mount. But this also means that the China parks are now the core of LEGO's physical strategy, not just one line in a sprawling global portfolio. The risk profile changes. Shanghai's early wins become more important, and so do any stumbles in Shenzhen, Beijing or Sichuan. The company's willingness to double down on this model is clear. Whether this mitigates risk or simply concentrates it remains an open question, and one that will be answered not by press releases but by the numbers each park delivers. Shanghai is the beachhead and the LEGO clubhouse, language that frames this as a campaign, not a test. Success here matters, but 4 parks mean 4 battles. Korea proves what happens when foundations crack. Is this a brilliant strategy or overreach disguised as ambition? Let me know your verdict below.